Well, thank you very much for inviting me. It's a really great pleasure to be here at this excellent conference. I mean, I've heard about this conference for the past 21 years, and it's a real pleasure to be here, and I'm sure I will enjoy my stay in Santiago and Chile. Let me first of all note that the views expressed are my own and not necessarily those of the European Central Bank. And the work I'm going to present is joint work with Jens Eisenschmidt, who is a colleague at the ECB. So I will be talking about the experience with negative interest rates in the euro area, which were implemented starting in June 2014 as part of an overall comprehensive easing package that the ECB put in place in response to what were at the time emerging deflation risks. And it's sort of important to put that policy in the context of this larger package because there were other components, and I will talk briefly about this. So what I want to do, and this is also the structure of the paper, I want to address this in basically four parts. In the first part, we basically document that the real zero lower bound is on interest rates on retail deposits of households with banks. That's where we see that it's very difficult for interest rates to go zero. Basically, banks are very reluctant to pass through negative market rates to their retail customers and to the remuneration or the charge on deposits. And so we document that for the euro area. And of course that raises a number of questions. First of all, why is it that banks are very reluctant? We speculate a bit in the paper, but don't really go into the substance of it. And the second question is, okay, if that's the distortion, if that's where you see this very incomplete or lack of pass-through, what does it imply for the behavior of banks in terms of the loan rates that they set? And of course, that's what matters for monetary policy. It's the pass-through to the financing costs of the private sector. And what does it mean for profitability, for loan volumes? And there is a literature developing that addresses that. And so in the second part, we review the very small theoretical literature that already exists. Basically, I mean, if you look at basic models of the bank lending channel or the risk-taking channel, then you can come to the conclusion that the effects of having this distortion on the funding side may go in either direction. I mean, one obvious argument is that if a bank is confronted with negative interest rates on the excess liquidity or the short-term bonds that it holds, while having to being funded by deposits which are remunerated at zero, then it will try to rebalance its portfolio towards higher yields. So there may be a search for higher yield. This is a kind of portfolio rebalancing effect, but it may also be a risk-taking channel effect, whereby the bank tries to go in the direction of higher risk assets. So that would actually strengthen, if you like, the transmission channel of monetary policy, because in the end, that's what we want to achieve. We want to achieve more loans, more credit growth through our policy. But then there's the other side, and this is of course where the reversal rate argument of Marcus Brunemeyer comes in. If indeed these negative rates lead to lower profitability of banks, that may actually weaken the bank. It may weaken the capital conditions of the bank, and therefore the bank may actually not want to extend or not be possible. It may not be possible for the bank to extend lending. And so there are these two, and of course this is a simplification of the possible effects you can have, but there's these two offsetting effects. And in the end, it's an empirical question, which of those effects and at what time they would materialize. And this is the third part. In the third part, we kind of review again, the emerging literature that looks at how banks behave in a negative interest rate policy environment. And of course, the way to try to identify is by looking at banks with different initial asset and liability positions. So if you think the negative effects sort of dominate, or if you want to see those, then probably you want to look at banks which have high retail deposit shares on the one hand, on the liability side, and sort of high interest rate sensitivity, for example, because they have large net excess liquidity on the asset side, and see whether those banks behave differently from the banks that are in the opposite situation. And that's what we do, as I said, in the third part. We review the literature and look just at the data for basically a set of German banks where sort of this constraint has been most binding in the euro area. What we find is basically there's very little evidence so far that bank behavior has been affected. At least in the euro area, the pass-through has been as normal as we've noticed it before. Of course, one implication, and also the pass-through to loans and loan origination is if anything, the literature suggests and the evidence suggests that there has been more loan originating, so that sort of bank lending channel has been more effective. But of course, if that's the finding, then it does imply that interest rate margins have fallen for those banks, because the reality is that funding costs for retail deposits are stuck at zero, whereas, of course, loan rates on the asset side of the bank have fallen. And so interest rate margins have fallen. And then the question is, first of all, if this situation continues to be the case for a long time, what does it mean for the banking sector? And may their behavior change? But secondly, what does it mean for overall profitability? And so in the last part, we kind of widen a little bit the scope of the analysis and sort of show basically some of our in-house analysis, which shows that it's true that interest rate margins have fallen, but that there are compensating effects. And if you actually look at bank profitability over this 2-year period that we have implemented negative interest rates, if anything, it has gone up. The return on assets has gone up a little bit. And the reason is because the drop in interest rate margins has been compensated by partly increases in asset values. As interest rates fall, asset values rise. But more importantly, by the fact that our stimulative policy has actually had positive effects on the economy at large and economic activity, which has brought down loan loss provisions on the one hand, and also has allowed banks to basically create more business. And of course, it may be at smaller margins, but there's a quantity effect which is positive. So that's kind of the outline of the paper. And in the presentation, basically, I will put a little bit more flesh to that outline. But before I do that, let me just briefly say a few words about the broader monetary policy background and the measures that we have taken, or that ECB has taken, starting in June 2014. And basically, this is probably not readable, but it's not really necessary either. I mean, what this sort of colorful timeline, it's a timeline starting in June 2014, ending 3 weeks ago, when we took, the Governing Council took its last decisions with respect to the asset purchase program. It gives you, all the boxes give you one element of the measures that we've taken over this period. The blue boxes basically, and there's 3 parts. There's blue, there's green, and there's sort of orange, yellowish. The blue boxes are the negative interest rate policy. And there were 2 waves of sort of easing in Europe. The first wave was in the second half of 2014, and that's the 2 first blue boxes, when we went from the deposit rate went from 0 to minus 20 basis points in 2 steps. At the same time, we also started a funding for lending program. That's the green box, whereby the bank would finance, the central bank would finance private banks against collateral for a longer term under certain conditions that it would use those funds to lend to the real economy and particularly to non-financial corporates. So very similar, details are different, but very similar to what the Bank of England has done early on in the crisis. And then the third component is a large-scale asset purchase program, which has both a private sector component, that's the yellow boxes, and more recently, the biggest component is a public sector purchase program. And so there have been 2 ways of easing. The first one was early on when there were these emerging risks of deflation and a slowdown of the domestic economy. Then there was a sort of an intensification of that package towards the end of 2015 and beginning of 2016, which was very much in response to the slowdown in the global economy and the sort of the fallout to some extent from the taper tantrum in the US, where the negative rate was lowered again now from minus 20 to minus 40. There was a new funding for lending package installed, where banks actually at this time, again under certain conditions, could borrow at negative rates with the central bank. And then there was an intensification of the asset purchase program from 60 billion per month to 80 billion per month. So that was end of 2015. And then since then, as the economy has responded to this stimulus, and particularly the easing, the very significant easing of financial conditions as a result of this stimulus, the economy has become much more robust, the recovery, the expansion, much more robust. Unemployment has been coming down from 12% to now less than 9%. And slowly there has been some normalization in the intensity of the easing, first in December 2015, and more recently it's still an easing, but at a sort of less, sort of the derivative, so to say, is lower. So 3 weeks ago the Governing Council announced that it will extend the asset purchase program beyond the end of this year until September 2018, but at a lower pace of 30 billion per month. I mean, the reason why I want to put the negative interest rate in this context is because obviously you can already see that it will be very difficult to distinguish what are the effects of the negative rates from what are the effects of the fact that we provided long-term funding to banks at very easy conditions, and what are the effects from the asset purchase program, which basically inserted quite a bit of excess liquidity in the system. I mean, what we argue as a bank is that these 3 components basically are complementary in many ways. Now, that's another paper to give. I won't go into there, but it shows the importance of also looking at the interaction, which is not something that I will do in this paper. In this paper, I will focus on the negative interest rate policy only. Now, how has the banking sector responded and credit bank lending responded to this overall package? Well, as I said, financial conditions were eased quite considerably across the board. Whether you talk about the exchange rate, whether you talk about stock markets, whether you talk about bond markets, there was a very significant easing of conditions as a result of this stimulus package, and we have lots of empirical event type of studies to back this up. But also the banking sector, which is the most important source for financing in Europe for the private sector, responded very sort of actively. And so, again, this is more as background, but of course you will see some of those graphs coming back. On the left-hand side here, what you see is the drop in the cost of borrowing, of bank borrowing from non-financial corporations since the start of this easing cycle, For the euro area, that's the dark blue line here. And for a number of countries. So one of the issues that we had in June or in the spring of 2014 is that there was a lot of fragmentation in the banking market. So lending rates in Italy, the green one, were much higher than lending rates in France, the blue line, because of the fragmentation as a result of the sovereign debt crisis. And so one of the things that our comprehensive easing package has done is basically it has dealt with this fragmentation, and nowadays the rates are back to what are more normal differences, which we saw also before the crisis. So you see a reduction of bank loan rates, quite substantial, more than 100 basis points, and a convergence across countries. This is for non-financial corporations, this is for households, more or less the same picture. Banks, they were very risk averse and tightened lending conditions a lot in the sort of the double dip recession episode that preceded this easing. So the great financial crisis, big easing, tightening of bank lending restrictions, sovereign debt crisis, again, tightening of sovereign debt restrictions. Because of our actions, you basically get an easing of bank lending restrictions. And as a result, so the cost drops, overall restrictions ease, the demand for loans, again, this is based on our BLS, our bank lending survey, increases both by households for house purchase and by firms for working capital for investment and so on and so forth. And of course, you see that also in the growth rates of credit. So if you just focus on the blue line, which is the euro area aggregate, at the start of this easing package, credit growth was negative at a rate on average of 3%. A lot of variation again across the euro area. Of course, Spain was, this is the yellow, was still very much recovering from or affected by the housing boom and bust. But you see that how over this period, gradually the growth rate went from a negative -3% to basically a positive +3, +2, 2.5%. And the same for households. So overall, clearly the banking sector became less fragmented because of our overall positive package and started providing, again, credit to the private sector at rates that were much lower. This is the background. So let me now go back to the four parts of the paper. So the first point is the real restriction is on deposit interest rates. And I guess that is sort of probably well known and sort of expected, but I just want to show you in our microdata how real that restriction is. It's not in market rates. Market rates have responded almost one for one. I mean, there was some adjustment period. So what I show here is this is our deposit rate, so the rate on the deposit facility with the central bank, the two early drops and then the two later drops. You see, actually, in the beginning, it took actually quite some time for the financial sector to adjust to this negative rate episode. And part of it was that excess liquidity was relatively low at that point. This was before we started the APP. But part of it was also an adjustment mechanism. Banks had to, and systems had to learn how to trade with negative rates. But once this adjustment period was done, and definitely once excess liquidity was again relatively large, basically you have an immediate and complete pass-through of the interbank EONIA market, money market interest rate to the deposit rate. The same is true for bond markets. If you focus on this green line, so this is the riskless OIS curve in the euro area, basically it's at -40 and it's expected to stay there for the next 1 to 2 years before then slowly going back. Actually, if you look at riskless safe government bonds, it trades at much lower rates than the -40. And of course, this is part of the result also of our asset purchase program, which creates some scarcity in safe government bonds. The real zero lower bound is on deposit rates of at households and non-financial corporates. This is probably not that easy to see from afar, but basically what it shows, again, for non-financial corporates, for firms and for households, the histogram of average deposit rates at each bank in the euro area. The light blue one is the one in June 2014, before the net negative interest rate policy period. The dark blue one is the one in June 2017, so most recent. And of course, what you see is there's a shift to the left of that distribution. But the other important thing is that there's a piling up at zero. So that's this big blue bar here at zero, and very little at negative rates, a bit more for non-financial corporates. So now you may ask, why is it that in June 2000, the average deposit rate was still 83 basis points, 0.8%. Now this has to do with this fragmentation that I pointed to later of the financial markets. If you sort of decompose the average deposit rate, bank deposit rate, which is the, actually I don't have it, I don't have here, but if you decompose this average deposit rate into the deposit rate in core countries and the deposit rate in periphery countries, you basically get this picture. The orange side is in the periphery countries, the blue one is in the core countries. So the starting point was very different. You know, in the periphery countries, because of the sovereign debt crisis, and to ensure sort of deposit funding and avoid basically a runoff of deposits, banks in the periphery had to raise their deposit rates quite considerably to retain deposits. So the funding costs rose a lot during the crisis, not only in the markets, but also for deposits. And it's only with President Draghi's whatever it takes and the OMT decisions that sort of the crisis subsided, and we have this. And so when we implemented the negative interest rate policy, actually in the periphery countries, deposit rates were still relatively high. So if we want to look at what the constraint really does, we will look most at German banks and of course core country banks, because that's really where deposit rates were already very low, and you see that they didn't follow the drop in the deposit rate. And this is, again, another way of showing that actually the point of this graph is to say that there is basically almost no negative rates on household deposits, but there is actually a lot of negative rates, and this is for Germany, on deposits of corporates, non-financial corporates. What this graph shows is the share of deposits that have negative rates of non-financial corporates that have negative. And basically, as of beginning of 2016, it stands at 70%. So there is actually, there's no zero lower bound, or at least it is not very strict for corporates, but it is for households. For households, I mean, there's some, but it's basically 2.5%. It's very. Okay, now what does that mean, this distortion? What can it have these negative effects, or actually will it help in strengthening the bank lending channel? And okay, in the paper we kind of try, I mean, it's very, by the way, the paper is very preliminary, so basically it was written not so long ago, and we have some work to do also in terms of surveilling the full literature. But basically what this slide does is it kind of gives the two possible interpretations, and of course in reality both may be true, or two possible effects. That a situation of a bank whereby on the one hand it cannot lower its funding rate below zero for a big part of its funding base, which is household deposits. On the other hand, it's faced with negative rates on short-term assets and negative rates on excess liquidity, which is quite substantial in the case of the euro area market. So one reaction is to say, well, most likely this will actually strengthen the bank lending channel. It will strengthen risk taking. Why? Well, part of it is plain portfolio rebalancing. If you have a part of your assets that are now trading at negative rates, I mean, you may want to try to get out of that by giving out more loans, which have positive interest rates. Now, this is what is sometimes called the hot potato effect, because, of course, the aggregate excess liquidity is I mean, banks cannot change. No? That's determined by the asset purchase that we do. But, of course, from a partial equilibrium perspective, from banks' perspective, that is exactly what they may want to do, particularly those banks that have high excess reserves with the central bank. It may also spur risk-taking. If you think, I mean, one of the, of course, arguments for low rates having risk, leading to more yield, search for yield and more risk-taking, is that with low rates, basically the franchise value of the bank will fall, profitability will fall over the future, and so the costs, if you take risks and actually they go the wrong way, are less. So the incentives are higher. So you can think of another reason is sometimes people say, well, it's because they're nominal sort of yield benchmarks. If zero interest rates is a nominal yield bank in a world where many rates are negative, then again, it may lead to search for yield. So there's a number of arguments that you can think of and that are now being explored in the literature to say negative rates and this distortion on deposit rates may actually spur more lending relative to the normal situation, and more risk-taking. But then there's the counter-argument, which is basically, I think, made famous by Marcus Brunemeyer and his co-author Kobe, which is about the reversal rate argument. Maybe if you go too far, what may happen is that low interest rate margins and profitability due to the negative interest rate tighten capital constraints and therefore may offset the positive impact of tighter asset values on those constraints. I mean, the point of this review is just to say, well, we can now look at the evidence and see whether indeed banks that are more affected, and these are the banks that have higher retail deposit shares on the liability side, and the banks that have higher interest rate sensitive assets on the asset side, either because of excess liquidity or short-term government bonds or variable rate loans, whether those banks' behavior is different from the banks that are less affected. And this is where part of the literature is now going. Just to show you in the euro area data, there is a lot of dispersion in terms of those features. No? What this graph shows is the histogram of deposit shares in the euro area. So there's some banks which basically are funded almost 90% by retail deposit shares. There's a big 25% of the banks actually don't rely on retail deposits for funding, and there's a whole distribution. So this is kind of a good sort of variation that we can use to try to see whether effects are different. If you look at excess liquidity, the share of excess reserves in total assets, I mean, on average, if you average non-consolidated bank balance sheets, it's about 6% of assets. You see most banks actually don't have that much excess liquidity, but there are some banks that have higher shares, but the shares are sort of less important if you compare with retail shares. So what we do in the paper, we focus mostly on the retail deposit share as sort of to differentiate bank behavior. The other thing, of course, you can try to look at is the extent of variable versus fixed rate financing in the loans of banks. Unfortunately, we don't really have, at least I don't have, probably the supervisors do, but we haven't had access to bank level information about variable rate financing, but we know these shares more or less per country. And you see it's very different, actually. In Germany, most of the loans are at fixed rates. The same is true for France, whereas in Italy and Spain, a much bigger share is variable rate financing. And again, this will matter because, of course, if you have variable rate loans, then when the interest rate market rates fall, become negative, then obviously the loans will return on the loans will adjust to this drop. Whereas if you have long-term fixed rate loans, you will be less affected, at least in the short run. Okay, then I have 2.5 minutes. Let me speed up a bit. Look at the third part, which is, okay, what's the evidence? In the paper, we kind of review what is a rapidly growing literature, trying to look at the effects of negative interest rate policy. These are sort of 5 papers that, I mean, they've all been published or circulated in this year, so it's a very recent literature, and for sure there still has to be done some vetting whether the results are robust and general. But, and I'm not going to go to each of them. I mean, what's nice is they all use sort of somewhat different data and different methodologies. One is a diff in diff methodology. The other one is looking at how excess liquidity affects loans, so the composition of assets. Another one is trying to look at announcements of monetary policy and how they lead to pass-through in lending and interest rates, that the Browning and Wu. The bottom line is that most of these papers show that, first of all, there's very little or no evidence that the pass-through in the euro area has been less from market rates to bank loan rates. Secondly, there's quite a bit of evidence that for high deposit banks, if anything, loan origination has increased. So it strengthens, if you like, the bank lending behavior. It probably also strengthens risk-taking. Now, to the extent that that's part of the transmission channels that you want to operate, that's a good thing. Of course, from a financial stability point of view, you may have other views. And so that's my summary. I mean, there is one paper, Heiders Schepens, I think that has been around for the longest, where they look at, which is probably the most sort of detailed and robust by that time. But they look at syndicated loans, which is a very small part of the overall asset balance sheet of banks. They find actually, in contrast to many of these other papers, that high deposit banks lend less, but they do take more risky borrowers. As I won't get to the last part, let me just give you sort of our evidence that, or our look at the microdata, bank microdata. So now we're basically focusing here on German banks because they are the ones where deposit rates are most constrained. And we look at, it's very simple, and this is not, we should do much deeper sort of econometric analysis, so it's just suggestive evidence. We basically split these 50 German banks into 5 quintiles with low deposit shares and high deposit shares. So 5 quintiles from low to high. And then look at the pass-through or to loan rates after the start of the negative interest rate policy and how their market shares have increased. So if you think the negative effects dominate, then you should see here a positive slope. So for high deposit banks, you would expect less pass-through, whereas we see the opposite, if anything. So there's more pass-through. Whereas for loan shares, you should see, again, a negative slope. So basically, high deposit banks are more refrained in lending, and so they lose market share, whereas low deposit banks should gain market share. If anything, you see the opposite, although this is very small and probably not significant. So basically, nothing has changed. We compare that with the previous period, the pre-NRP period. More or less, we have the same picture, actually. This is the same picture. So it doesn't look like anything has changed in the NRP period. In the last section, then, we put this in a broader context and show that overall profitability has not been affected by our policies because there are these compensating effects. But I don't have time to go to that, so let me just put in the concluding slide, which says that the friction associated with negative rates is really that household deposits are floored at zero, and I think it raises a number of interesting questions why that is the case. There is no sign of a reversal rate in the euro area so far, and overall our experience with negative rates in conjunction with the other components of our easing package, the asset purchase program and the TLTROs, has been very positive. Thank you.